You have probably looked at the price tag for a financial advisor and thought exactly what most financially aware people think. I can do this myself. I have got spreadsheets. I have read the books. I follow the podcast. Why would I pay someone $2,000, $5,000 or more for something I can figure out on my own? That thinking is logical. It is disciplined. And in many cases, it is exactly how smart people make genuinely expensive mistakes. Not because they are careless, but because the math they are running is only showing them part of the picture. Here is the paradox. The decision to not pay for a financial plan is often one of the most costly financial decisions an American man in his 30s, 40s, or 50s will ever make. Not because advisors are magical, but because the gap between what you think you know and what the numbers actually show is almost always wider than you expect. And that gap has a price tag attached to it. Before we run any numbers, let me establish the baseline we are working from, because financial conversations go sideways fast when everyone is starting from different assumptions. We are working with these US-specific parameters throughout this video. Inflation rate, 3.1% annually, based on the 12-month CPI figure through early 2025. Source, Bureau of Labor Statistics, 2025, Federal Income Tax Bracket. We will use the 22% marginal rate, which applies to single filers earning between $47,151 and $100,525, and to married couples filing jointly between $94,301 and $201,050. Source, IRS Revenue Procedure 2024-61, Investment Return Assumption. 10% nominal annual return on a diversified S&P 500 index portfolio, or approximately 7% after inflation. This is consistent with the long-run historical average since 1926. Source, Morningstar and S&P Dow Jones Indices. Target viewer, a man between 35 and 55 with a household income somewhere between $85,000 and $175,000, who has some investments already, likely a 401k, maybe a Roth IRA, possibly some taxable brokerage accounts, but who has never worked with a fee-only certified financial planner. One important note before we go further. This is not personalized financial advice. Consult a certified financial advisor for your specific situation. What we are doing in this video is showing you what the math looks like at scale, so you can make a more informed decision about your own approach. Now, with those numbers established, let us look at what most financially intelligent people choose to do. If you are the kind of person who manages your own finances, you have probably already built something real. You are contributing to your 401k, maybe even maxing it out. You have a Roth IRA. You have read about asset allocation and understand the difference between a mutual fund and an ETF. You are not the person who leaves money sitting in a savings account earning 0.01% interest. That is not nothing. That is far ahead of most Americans. According to the Federal Reserve's 2022 survey of consumer finances, only about 54% of American families own any stocks at all, directly or through retirement accounts. If you are actively managing a diversified portfolio and thinking long-term, you are already in a minority, and a sophisticated one. The case for doing it yourself is genuinely compelling. The most common fee structure for financial advisors is 1% of assets under management per year, known as an AUM fee. On a $500,000 portfolio, that is $5,000 a year. On a $1 million portfolio, that is $10,000 a year. Every single year. And that money does not just disappear into a fee-line item. It disappears from your compounding base. There is also behavioral science behind the DIY instinct. Research from Dalbar Associates consistently shows that people who feel in control of their own financial decisions tend to stay the course during market corrections more than people who feel detached from their portfolio. Ownership of the process matters psychologically, and that is a real advantage. And with the rise of low-cost index funds from Vanguard, Fidelity and Schwab, the playing field has been leveled significantly. You do not need a professional to tell you to put money into a total market index fund. That is information you can access for free anywhere on the internet, and it is genuinely good advice. The DIY choice has real merit, real logic. Smart, financially aware men make it every day. Here is what changes the whole calculation. The cost of a financial advisor is a number you can see clearly. It shows up as a fee, a statement line, an invoice. The cost of not having one is a collection of invisible losses that never arrive as a single bill. And that difference in visibility is precisely why most people get this decision wrong. Let me walk you through the layers one at a time. Layer 1. The tax inefficiency you do not know you are carrying. One of the most consistent findings across financial planning research is that tax optimization, done correctly, can save a DIY investor between 1.5% and 2% of their portfolio value per year. Vanguard's Advisors Alpha study, updated in 2022, puts the value of tax-efficient portfolio management at approximately 1.1% per year. Morningstar's Gamma Research Framework, which models the impact of sound financial planning decisions, identifies 1.82% per year in improved outcomes from working with a structured financial plan. Sources: Vanguard, 2022. Morningstar, 2022. What does that mean in real dollars? On a $400,000 portfolio, a reasonable accumulation for a 45-year-old who has been saving since his early 30s, a 1.5% annual tax efficiency gap costs $6,000 per year, not as a fee, as silently foregone returns that never announce themselves. As specific mistakes that gap captures are straightforward to describe and extremely common to make. Most DIY investors hold their bond funds and dividend-paying stocks inside their taxable brokerage accounts, where they are taxed every year as ordinary income or qualified dividends. A well-structured plan flips this arrangement. Tax-inefficient assets, the ones that generate regular income, go inside a Roth or traditional IRA. Tax-efficient growth assets, the ones that appreciate without distributing income, stay in the taxable account. The IRS taxes capital gains at 0%, 15%, or 20% depending on your income level. Source: IRS Publication 550. The difference between paying 22% ordinary income tax on bond interest versus 15% long-term capital gains tax on an index ETF sale is not marginal. Over a 10-year period on a $400,000 portfolio, that compounding tax rate difference alone can add up to more than $60,000. Layer 2. The Roth conversion window that most people leave open and empty. This is one of the most quantifiable missed opportunities in American personal finance, and it affects almost every man in the 35 to 55 range who has a traditional 401k or IRA. Here is how the opportunity works. Most high earners in their peak working years are in the 22% or 24% marginal tax bracket. When they retire and stop earning, many fall temporarily into the 12% or even 10% bracket. That drop typically happens between age 60 and 70, after earned income ends but before Social Security benefits begin, and before required minimum distributions force taxable withdrawals starting at age 73. Source: IRS Secure 2.0 Act, 2022. That window between roughly age 60 and 70 is when you can convert traditional IRA money to a Roth IRA at a lower tax rate than you paid going in, or a lower rate than you will face later when RMDs force distributions at a rate you cannot control. Roth assets then grow tax-free for the rest of your life and pass to your heirs without triggering income tax. Vanguard's research shows that a properly executed Roth conversion strategy can be worth between $100,000 and $200,000 in lifetime tax savings for the typical American household with $500,000 to $1 million in pre-tax retirement savings. Source: Vanguard Retirement Research, 2023. Most DIY investors never execute this strategy, not because they could not learn it, but because they never modeled the multi-decade tax trajectory that would make it obvious. Layer 3. Social Security optimization, the six-figure decision hiding in plain sight. Most Americans claim Social Security based on intuition or short-term cash flow pressure, not on math. The Social Security Administration's own data shows that the average retiree claiming at age 62 receives approximately $1,298 per month. The same worker claiming at age 70 receives approximately $2,280 per month. That is a 76% difference in monthly income that continues for the rest of their life. Source: Social Security Administration, 2024. For a married couple, the optimization becomes significantly more complex. It involves when each spouse claims whether to use spousal benefits, and how to sequence those decisions against portfolio drawdown. Studies from Boston College's Center for Retirement Research estimate that suboptimal Social Security claiming decisions cost the average American household between $111,000 and $182,000 in lifetime benefits. Source: Center for Retirement Research at Boston College, 2022. And this decision does not exist in isolation. It interacts with Medicare premium thresholds, Roth conversion timing, and RMD planning. A DIY investor optimizing each of these independently, without modeling how they affect each other, will almost certainly leave a significant amount of money on the table. Now let us run the full simulation across time. Two men, both 45 years old, both earning $120,000 per year, both with $400,000 already invested across a 401k and a Roth IRA. One manages his own finances with real discipline, consistent contributions, low-cost index funds, no major behavioral errors. The other pays $3,000 per year for a comprehensive financial plan from a fee-only CFP. We will run them both to age 65, a 20-year window. Checkpoint 1. Age 50, 5 years in. The DIY investor contributes $23,000 per year to his 401k, the 2024 IRS contribution limit, and $7,000 to his Roth IRA. Source: IRS Notice 2023-75. His portfolio compounds at 10% nominally. At year 5, his total portfolio sits at approximately $840,000. The planned investor makes identical contributions, but his advisor has implemented asset location strategy, reducing effective tax drag by 1.5% per year on taxable accounts, and has begun a modest Roth conversion plan during a lower income year. At year 5, his portfolio is approximately $872,000. The gap? $32,000. He has paid $15,000 in planning fees over 5 years. He is ahead by $32,000. Net return on the planning investment after fees: $17,000. Checkpoint 2. Age 55, 10 years in. Both men are now earning $140,000. Both have hit age 50 and added catch-up contributions. An extra $7,500 to the 401k beginning at age 50, and an additional $1,000 to the Roth IRA. Source: IRS Secure 2.0 Act, 2022. The DIY investor's portfolio, compounding at 10% annually with consistent contributions, is approximately $1,610,000. That is a real achievement. The planned investor has made the same contributions but has also executed $40,000 in Roth conversions across 2 lower income years in his early 50s, avoiding the 24% bracket on that money and locking in the 22% rate instead. That alone saved approximately $800 in taxes on those conversions. His advisor also consolidated his holdings from 5 funds down to 3, reducing the overall portfolio expense ratio by 0.18 percentage points. On $1,600,000, that is $2,880 per year in reduced drag, compounding forward. His total portfolio at age 55, approximately $1,698,000. The gap? $88,000. He has paid $30,000 in planning fees over 10 years. He is ahead by $88,000. Net return on the planning investment, $58,000. Now, this is where behavioral psychology enters the calculation in a way that is measurable rather than theoretical. The phenomenon driving most DIY investors to reject financial planning is called present bias. Present bias is the documented human tendency to overweight immediate costs relative to future benefits, even when the future benefit is far larger and statistically certain. A $3,000 fee today is viscerally real. An $88,000 advantage in 10 years is abstract. The human brain does not weight those two things equally, even when a rational calculation clearly favors paying the fee. Dalbar Associates' quantitative analysis of investor behavior, which has tracked actual investor returns versus market returns for more than 30 years, finds that the average equity investor underperforms the S&P 500 by approximately 1.7% per year due to behavioral timing errors, buying after the market rises, selling during corrections, chasing recent performance. Sourced: Dalbar QAIB, 2023. On a $1,600,000 portfolio, 1.7% per year is $27,200 in foregone returns annually. The planned investor does not eliminate this risk entirely, but having a standing relationship with an advisor who answers calls during a market sell-off meaningfully reduces the probability of a panic decision at the worst possible moment. Checkpoint 3. Age 65. Retirement. The DIY investor, after 20 years of disciplined investing, has approximately $2,960,000 in total assets. That is genuine wealth, built through consistency and low-cost investing. It is an outcome most Americans will never reach. Now the planned investor at 65. 20 years of the same compounding with a 1.5% annual tax efficiency advantage maintained throughout, a Roth conversion strategy executed between years 8 and 14 reducing his future RMD burden substantially, and a Social Security claiming strategy coordinated to delay the higher earner's benefit to age 70, allowing the portfolio to draw down more slowly in the early retirement years using other assets first. His total portfolio at 65, approximately $3,320,000. The gap at retirement, $360,000. He paid $60,000 in planning fees over 20 years. He is ahead by $360,000. Net return on the financial planning investment over 2 decades, $300,000. And this does not yet count the Social Security optimization benefit. If the advisor's claiming strategy generates even $120,000 more in lifetime Social Security income, which is conservative relative to the Boston College estimate of $111,000 to $182,000, the total measured advantage of having a structured financial plan reaches $420,000 over the retirement horizon. That is not a minor administrative benefit. That is the difference between a portfolio that generates $118,400 per year at a 4% withdrawal rate versus one that generates $132,800 per year, every year, for the rest of his life. This is not personalized financial advice. Consult a certified financial advisor for your specific situation. Every individual's tax circumstances, risk tolerance, and retirement timeline is different. These projections are illustrative, not guaranteed. Now let us be honest, because intellectual honesty is what this channel is built on, and it is what you deserve. There are specific, real situations where DIY financial management clearly wins. And I would be doing you a disservice if I did not tell you exactly when. If your total investable assets are under $100,000, a comprehensive planning fee of $2,000 to $5,000 per year represents 2% to 5% of your entire portfolio. That cost-to-benefit ratio is very difficult to clear in most scenarios. At this stage, a one-time financial plan from a fee-only planner, sometimes available for a flat fee between $500 and $2,500, makes far more sense than ongoing management. You get the structure without the recurring cost. If your financial situation is genuinely simple, one employer, one 401k, no taxable accounts, no pension, no business income, and you will never earn above the 22% bracket consistently, then the complexity premium that a planner provides is low. A disciplined 3-fund portfolio with automatic rebalancing is mathematically sound and a legitimate long-term strategy for someone with this profile. The advisor's value add in this case may not exceed the fee. And if you are highly financially literate, disciplined, and willing to invest serious time to master asset location, Roth conversion laddering, RMD optimization, and Social Security claiming strategy as a system, not as isolated decisions, the DIY path is viable. But the time cost is real, and the IRS code is not intuitive. Complexity increases sharply as net worth grows. Here is the higher financial principle that this decision points to, one that applies far beyond the question of whether to hire an advisor. The most expensive financial decisions are almost never the ones with visible price tags. They are the ones that come with no bill, no invoice, no monthly charge, no line item in your bank statement, the tax drag you never measured, the conversion window you left open and unused, the claiming strategy you never modeled, the behavioral timing error you made in March of a down year. These are the losses that accumulate quietly and do not reveal themselves until it is too late to course correct. A loss aversion bias, which is the human tendency to feel the pain of a loss more intensely than the pleasure of an equivalent gain, makes the fee you pay a planner feel significant. But loss aversion works against you by making you far less sensitive to the invisible losses already happening inside a plan you think is working. The discipline of paying for clarity, whether that comes in the form of a comprehensive financial plan, a one-time tax strategy session, or professional portfolio review, is not a sign of financial weakness. It is a sign that you understand the most important asymmetry in personal finance. The cost you can see is almost never the largest cost you are paying. This is not personalized financial advice. Consult a certified financial advisor for your specific situation.